Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Many of our listeners will be aware of our main site, macrohive.com, where we showcase great analysis from our team and from outside contributors. It's great value and you should sign up if you haven't already. But there is another side to MacroHive, where we deliver much more in-depth analysis, which incorporates things like trade ideas, models, and insights from our broader network. And if you want to learn more about this, feel free to drop me an email and I can tell you all about it. We also do a lot of bespoke work for companies on anything macro related, whether that's scenario analysis, deep dives on certain trends, or even model building. And for that, we often pull in expertise from our network and MacroHive community. It's one of the aspects of MacroHive that I really do enjoy. So if your company needs some help on the macro front, again, get in touch with me. Or if you have some expertise you want to share and become part of our network, let me know too. Speaking of top expertise, on this week's podcast, I have a conversation with John Llewellyn. John is the co-founder of Llewellyn Consulting, a leading independent economic advisory firm. I should add that we're really happy to have the firm in our network as they produce some of the best big picture research out there. In terms of John's background, before setting up the firm in 2009, John had various senior research roles, including being the global chief economist at Lehman's. He was the head of international forecasting and policy analysis at the OECD, and he taught at the Faculty of Economics at the University of Cambridge as well. So, without further ado, onto our conversation. So, John, welcome to our podcast show, and thanks for giving us your time to speak today. I thought I'd kind of kick off really with your take on the COVID recession or depression or slowdown or however you want to call it. Like, typically, we're used to recessions either caused by tight monetary policy, often in response to high inflation, or by some kind of asset price or excessive sort of credit bubble that implodes. Those are kind of the typical recessions we're used to. Now, this obviously is very different. How do you think about this type of recession and then the kind of recovery from it?
Well, I think your opening observation is fundamental, that most recessions are in some sense endogenous to the system. They're determined internally. And this one's been imposed from outside. And really, there's no precedent for this because even previous pandemics have not been met by this kind of response. So we really are arguing a priori. And in one more throat-clearing remark, I would make the point that if you look at the ability of forecasters to forecast, which is really what we're discussing here, what will happen, you find that their errors fall into two groups. A very large number of comparatively small errors and a very small number of very large errors. And the characteristic of those occasions when they make large errors are when the situation was novel and the shock was large. Perhaps the most important example of this, there are many. The first oil shock, which was a shock of about 2% of OECD GDP, was not only large, but it was novel. And forecasters made huge mistakes. They made, on average, an error in their GDP forecasts for the following year of 4 percentage points. Massive. By the time of the second oil shock in 78, 79, which was the same size, almost exactly, they'd learned how economies respond to this. And the errors were no larger than they typically are. So we should start by being properly humble and recognize that we really do not know. One piece of guidance that I think we can get is to look at all the past recessions anyway. That's the natural starting point, even though they're caused differently. And if you look back, all the major recessions in a whole range of major countries since the 1920s, one way of expressing what that reveals is how long it takes for GDP to get back to the immediate pre-recession level. And the answer is, and I have to say I was somewhat surprised about this, it's 3 to 6 years typically, and sometimes more. We have to be very careful when we read conjunctural commentary, which says, we've got a V-shaped recovery and GDP is recovering, well, it was said the other day, at 1% of GDP per week. That's what happens when you come out of the trough. But it's altogether a matter of sustaining that. And as I say, getting back to the level you started with, typically 3 to 6 years. Now, I suppose the question then becomes, is recovery likely to be quicker or slower from this one than from others? My guess for what it's worth, and it's not a lot, but my guess for what it's worth is that it'll be slower because in the past, you haven't seen the big changes in consumer relative prices. You haven't seen the big changes in the structure of demand and hence supply that you're likely to see in this case. We're likely to see recovery here accompanied by an airline industry, which is permanently smaller, a cruise ship industry, which is permanently smaller, a change in the structure of retailing away from the high street and towards ordering online. These are big structural changes in important, large sectors of the economy. And one thing we know about economies is that when their structure adjusts, they lose some output until that's over. So it'll be, in our best guess, it'll be quite a few years before GDP gets back to where it was at the end of 2019.
Understood. So from, your remarks, it seems like all this discussion around V-shaped recoveries, W-shape or U-shaped, to some extent, that's almost like a red herring.
I think it's completely beside the point. Who cares what the shape is? It's where you're going to and how long it takes to get there that matters.
And, you mentioned some of these, sort of the structure of the economy changing. How were you thinking about structural changes before COVID? And what's COVID kind of done to those structural changes?
I think it's important to recognize that economies are going through a continual process of structural change. That's true in good years and bad. It's independent of the country. It's driven ultimately in many cases by technology, because technology is always entering the economy and changing how you do things and relative prices and so on. It's also driven by rising real wages normally, because as labor comes relatively more expensive than goods, you continually have to find new ways of producing things which economize on the use of labor relative to goods. So it's a steady process anyway. And at the human level, the process goes on all the time. If you take the United Kingdom as one example, fully 1/3 of people change their jobs between 1 year and the next. And about 17% of people change their jobs between sectors between 1 year and the next. And changing from one sector to another, that's a big thing. So structural change is continual.
Just to be clear there, you're saying that each year around 1/3 of the labor force is changing jobs.
Yes. 1/3 changes jobs, not necessarily to a job which is fundamentally different, of course. I mean, if you're driving a black cab and you go to work for Uber, that counts as a change in job, even though you may be doing much the same thing. But a lot of changes in job are much bigger than that. By the same token, in most countries, around 1/3, 1/10 of companies, now, of course, a lot of them are very small, but they die every year and they're replaced by new companies. So there's churn at the level of companies as well as level of individuals. It's rather as if you're looking at a lake and you observe that the level of the lake, which you can liken to the level of total employment or the level of total unemployment, if you like, and you observe that it doesn't change very much. And what you perhaps don't see is that underneath it, there's a big pipe bringing water in and another big pipe taking water out. And so the water in the lake isn't the same water for very long. Well, our economies are normally like that. When you get something like COVID coming along, that changes the structure of the economy even faster. And that itself, at a time when a lot of people would argue, I think rightly, that the world is in the early stages of the fourth industrial revolution. We're very well aware that this is a digital revolution, but going to change, it is changing fundamentally what we produce, where we produce it, how we produce it. And adjusting to that was a challenge. It's also an opportunity, but it's a challenge. And now you've got COVID on top. So I think we're looking at structural change at a pace that we've probably not appreciated since at least the end of the Second World War.
And you mentioned earlier that often these structural changes or technological changes are associated with rising real wages. Now, in recent years, this has been one of the big challenges for countries and governments from a policy perspective, that real wages haven't been rising. What's some of the reasons for that, do you think?
I think, as in economics, and as your question implies, there's more than one reason. One reason, certainly, I think, has been the rise of China as a competitor. If you think in the most simple economic terms, the world had a certain stock of productive capital. And then when China was admitted to the world, you suddenly increased the supply of labor relative to that capital all at once. And the simplest economic theory would say that would tend to depress the real wage, or alternatively, the share of wages in GDP. And that has certainly happened. Now, As time has passed, of course, China has, which is a high saving country, has invested heavily itself and added to the capital stock as well. And it's now a middle income country. And that phenomenon is markedly less important than it was. But for the better part of 20 years, it left its mark on people on middle to low wage incomes producing competitive manufactured goods. So that's part of it. Another part of it, undoubtedly, is that technical change has widened the distribution of income. If you happen to be in the right industries in Silicon Valley, for example, your starting salary is $100,000 and it's there on up. And yet at the same time, if you walk the streets of San Francisco, you can see people whose industries and sectors and jobs have been left behind, and they're lucky even to have a house. So we've seen a widening distribution of income. And then thirdly, if you take aggregate economies, the level of investment has been rather poor, rather weak. And we have not been investing on the scale in which we did in the 50s and the 60s and the 70s. So it's a combination of reasons, but they've all pointed to stagnation of output growth, stagnation of productivity growth, and hence the stagnation of real wage growth.
Understood. I mean, there's been some kind of debate around, are we measuring things correctly? You know, is there some hidden productivity that we're not capturing? Or on the investment side, perhaps, you know, are we not capturing intangible investments? You know, so with all these tech companies, much of their assets are really intangible, you know, the size of their networks and those sorts of things. Yeah, how do you think about those sorts of things?
Well, there's no doubt that we're not capturing intangible investment fully. It's a real problem for the statistical authorities. You can see the nature of the problem if you buy a software program. If you buy a computer, that's regarded as an investment. If you buy the software program that makes it work, that's regarded as consumption. And that doesn't make a lot of sense. And lots of examples of that sort. But of course, there's a paradox here. If investment is being underestimated, and some people would say that investment could well be running half as big again as the numbers say. But if that's true, then other things being equal, that implies productivity growth is even slower than we thought, because productivity has been what it was measured as being. Now, others will then argue, yes, but we're measuring output growth wrongly as well. And that's probably true. That's probably true, because we can do all sorts of things now that we couldn't do before. It's a moot point sometimes to what extent that's an increase in productivity. If you can now, as you can, book your own airline tickets, to some extent that gives you options you didn't have before. And maybe in any hedonistic measure, that would say that's increased your welfare, your utility. On the other hand, it's also true that the travel agency has now pushed part of the job onto you, which is what they once did for you. So what the net balance of that is, I'm not sure. I would be inclined to say, yes, there's something in the measurement problem, but when the whole of a new phenomenon is put down to measurement problem, and no statistician can come up with a measurement correction that deals with all of it, I think it's probably only part of the story.
Yep. No, that's a fair point. And I suppose a related point to this aspect of the economy is inflation. You know, we haven't seen as much inflation as people were expecting. You know, many people thought after 2008, central banks were massively expanding their balance sheets. People were talking about printing money and so on. Yet we haven't really seen sort of meaningful increases in inflation. How do you kind of square the circle there?
To be frank, we never really expected to see large increases in inflation. There's been debate through the centuries about what determines wage inflation. Probably too much weight has been placed on the Friedmanite observation that inflation is and everywhere a monetary phenomenon. In one sense, it's a truism. You show me an economy in which there's rapid inflation, and I'll show you an economy in which the money supply is growing very fast. But that pushes the issue back to what makes the money supply grow very fast. And it can be many things. There's certainly very little doubt that if you have strong trade unions and or strong in wage indexation, such as, for example, the world had in the 70s, inflation is a self-perpetuating phenomenon. You get something like an oil shock, which we had in 1973-74, pushes the price level up by several percentage points. That was fed automatically into wage increases by indexation agreements, de facto or de jure. Those wage increases were so large that they had to be passed back into prices. And before you knew where you were, virtually all of the Western economies had inflation rates in the high teens or the low 20s. So that was one case in point. Strong unionization, that is undoubtedly a case in point because wages are to some extent the result of a bargain. And they, as Joan Robinson always used to insist, they're the result of a political negotiation between workers on the one hand and bosses on the other. And now unions have very little power in most sectors except the public sector. We've seen the rise of the service economy. We've seen the rise of the gig economy. We've seen fragmentation of unions. So there's very little ability of wage earners to raise prices. So in those circumstances, even before COVID, it was quite hard to see an inflationary impulse getting underway. And the United Kingdom was an interesting case in point. Sterling depreciated by about 20%. It raised the price level by about 2%. In the old days, if one can call them that, that would have set off a wage price spiral. You can't see it in the price data.
No. And so your outlook on inflation then sounds like you aren't too concerned about big increase in inflation in the coming years.
No, in fact, I'm concerned that there won't be any increase in inflation in the coming years because there's very little doubt that a modest amount of inflation, a couple of percent or so, does grease the wheels. I mean, if it does nothing else, it gives central banks the opportunity to take interest rates up into mildly positive territory and then have some scope thereby to cut them when they need them to support the economy. When inflation is near zero, and interest rates are negative, as they are at the moment in bond yields, for example, in some countries are nearly 1% negative, that really neuters monetary policy from having any effect. Now, I don't want you to think that one should be totally casual about inflation, because at some point, who knows when, the economy will be back to full employment. At some point, there'll be pressure on commodity prices again. At some point, oil prices will rise. They won't perhaps be quite as important in these days of wind farms and solar farms as once they were, but nonetheless, they'll be important. Inflation will get underway again, interest rates will rise, and there'll be some normalcy as a result. But if we're right in thinking that it'll be 3 to 6 years before we get back there, it's not top of one's list of priorities at the moment.
Yeah. Last year there was big push by some of the major central banks to rethink their mandates, and there was a lot of work underway on their frameworks. Now, obviously, COVID has come and that's probably delayed things. But, there was some talk about, should central banks explicitly say that they will allow an overshoot of the inflation target? Should we have price level targeting? Should we have, ranges around the inflation target? There's been lots of debates around those sorts of things. There's kind of another question as to whether we're targeting the right type of inflation. Should we not just look at CPI? Should we look at broader measures of asset price inflation and so on? What's your kind of thinking around the central bank mandates?
Well, I think all of those, and that's a pretty exhaustive list you've given of the things that they were looking at. And you're quite right, they were looking at all of those. And what does that tell us? That tells us that contrary to what a lot of people would have believed, and frankly, contrary to what I would have thought in earlier epochs, it's much harder for a central bank to generate inflation than I had ever thought likely. As someone who lived through the 50s, the 60s, the 70s, and then into the 80s, in which central banks were continually leaning against inflation, one always imagined that it would be fairly easy for them to rekindle inflation if they wished. Because one of the things that I've had to learn in the later years is that when deflation or disinflation, whichever you want to call it, settles in, it's much harder for central banks to rekindle it than I, for one, and I think most people had imagined. And so I think what you were describing quite correctly is central banks looking for all sorts of ways to change inflation expectations. And they said, they tried all sorts of things. I have to say, I think they got nowhere. And Japan is probably the archetypal case. They would love to have got some inflation into their system. They've tried all ways from the central bank, and they've never succeeded. So probably we have to learn a lesson from that, is that the central banks, who have carried so much of the responsibility for dealing with the level of activity in the last 20 years, have probably come to pretty much the end of the road as to what they can do on their own. I think their mandate going forward will be to support fiscal policy. De facto, they'll have to be supporting fiscal policy.
Yeah.
and then they will have to support that in a way which is responsible, constructive, but doesn't lead to a complete breakdown in fiscal responsibility.
And actually, on that note of fiscal policy, it's become quite fashionable today to talk about MMT, modern monetary theory. And, it seems almost like it's a free lunch almost. You can just, spend however you want, and there's no real need for discipline. First of all, I think there's also an issue of how we define MMT. It means different things to different people. But, perhaps if you define MMT first, in your understanding, I know you've done some work in this area, and then talk about, whether it is a valid policy path.
Well, I think the essence of what you might call pure monetary MMT, monetary finance, is that the central bank simply finances government expenditure which is not backed by taxation. And in the normal course of events, I stress, let's start from the normal course of events, that would be wildly irresponsible if carried on at any substantial scale whatsoever, because in normal circumstances, the economy is at or near full capacity. And therefore, if the government wishes to spend more, it has to be at the expense of some other group in society, which is to say consumers or investors spending less. And you can't circumvent that simply by saying, oh, well, the central bank will print it instead. So in normal circumstances, MMT is a supremely irresponsible policy. The issue is, how does that conclusion change when you've got a large amount of spare capacity? In essence, that was the issue that Keynes faced, because that is a different game. And one way of seeing that is just to invert the argument of saying, if we've got a lot of spare capacity, if we've got a lot of idle people, all of whom could usefully be producing output, if only there was some nominal demand, why should you not have it simply because it's been decreed that the central bank should not intervene and that the government should balance its books? That makes no sense. So there you have the other extreme. Now, from my experiences with central bankers, however, they are understandably cautious about opening the MMT box, because the risk is that if they are seen to be financing government expenditure on any scale without the government having to match that by expenditure increases, then politicians, the vast majority of whom are unscrupulous, will come along and say, now you've shown it to us. You've proved to us that we don't have to match our expenditure with taxation. And as soon as that happens, and as soon as the economy is back at or near full employment, were that view to continue to prevail, it would ultimately lead to financial collapse, because it would lead to hyperinflation and collapse in trust in the banking system. So central bankers always having to steer a tricky course. On the one hand, they're wanting to meet the legitimate requirements put to them by elected politicians, when they know that they themselves as central bankers are not elected politicians, and they're there to serve those politicians' expressions of the public interest. On the other hand, the last thing they want to do is hand over a system which has been messed up, is not fit for purpose, to a subsequent generation of people and politicians. So they try to maintain a certain mystique about monetary finance. You also, in your question, hinted at something else, which I think is a very important point. Extreme believers in monetary finance believe it's the cure for absolutely everything. That you could finance a minimum wage, all the investment that you need for a green revolution, etc., not only now, but in perpetuity. This is patent nonsense. So when we talk about monetary finance, we're very careful. We say there is a case for it when an economy has a lot of spare capacity, when there's no inflation. But on the other hand, it has to be circumscribed. And in our view, what you need to do is a government has to tell its people fairly and honestly the conditions under which it would begin to use monetary finance and the conditions under which it would end monetary finance. And then it should use an independent body to say when those conditions have been met. In the case of the UK, that would be particularly straightforward, because you've got the Office of Budget Responsibility, which is credible. It's got a track record, and it could certify that the conditions have been met. And then later it could certify that the conditions had not been met.
Yeah. And, I guess we can sort of pick a sort of a topical example here. Recently, the European Union came up with their sort of the budget for the next 5 years and the EU Recovery Fund. Something like that, where the Europeans essentially have some kind of fund to help countries heavily affected by the pandemic. And then also in terms of their longer term budget, they want to allocate money towards the green revolution and so on. How would you assess that kind of overall package? Do you think they did a good job or a bad job?
Frankly, I was gobsmacked by that package. Although I've been someone who, relative to prevailing UK opinion for a lot of the time, have thought that Europe had a better chance of holding together and being a success than was thought in this country, even I was beginning to have my doubts when I observed Europe, for example, failing to secure a banking union, failing to secure fiscal transfers in times of recession, when I observed the difference in political outlook between the North and the South. I was beginning seriously to question whether the euro could long-term hold together. And if that can't hold together, then probably Europe can't. So when I first became aware of the likely contents of this package, we were very fortunate to be able to talk to the man in the commission who put the whole thing together. I listened with my colleagues to this and thought, this is extraordinary. This is exactly the package we would have put together. It's got transfers from the North to the South. That's a plus. It's quite importantly big in terms of the absolute size of the stimulus. It also has in it the elements of an embryonic capital market, because the bonds which are going to be created are going to be backed by all of the EU countries and then can be bought by investors, including the ECB in the secondary market. So, and a lot of the investment is going to be directed at environmental matters, which is good for long-term sustainability. And as if all that's not enough, this isn't going to be dispensed from the center, but individual countries are to put up the proposals and own the responsibility for the investment project, with the presumption that the Commission will say yes quickly and relatively easily. So it's an excellent package. I couldn't say that we could have devised a better one ourselves. Now, I got messed around a bit at the edges in the negotiating process, and the newspapers had a field day with that. But the fact is, it's an excellent package.
Yeah. And why do you think the Europeans were able to pull this off?
In a word, there's been a sea change in economic thinking in Germany. Germany has been the most Neanderthal country in Europe, possibly the most Neanderthal country in the world, ever since the Second World War, in thinking about deficits, any sort of deficit. Current account deficit, public sector deficit. It's always been, in German thinking, it's been equated very, very closely in a quasi-religious way with sin. I've listened to so many German officials over the years in the OECD, for example, denouncing deficits in terms which were pretty Lutheran, and saying if only countries would do what we did, what we do, they could all be in surplus. I actually heard a German minister say that if all countries did what we did, everybody could be in surplus. Well, that's a logical nonsense. And it's been a huge problem within Europe and between Europe and the rest of the world, that thinking. Now it's changed in Germany. And the new German finance minister and his staff suddenly look modern. And by modern, I don't mean irresponsible. I don't mean careless. I don't mean negligent about inflation, but they simply recognize the laws of economic arithmetic, which is that for every surplus, there has to be a counterpart deficit somewhere and vice versa. And so they've looked now to the situation in Europe and they've analyzed it, I think, in the way that an American would, a Brit would, an Australian would, a Frenchman would. And that has made it possible for the French and the Germans to cooperate. And so suddenly we found, just as a result of this core change in thinking, a possibility for the French and the Germans, on whom the responsibility for a united Europe will always rest.
Yeah.
We found them able to agree.
And, in contrast, we have the US, and they launched, I guess, a very large fiscal package early on during COVID, and now they're kind of wrangling and it's losing steam. How do you view the US fiscal policy or stance?
I think like that in most other countries, it was impressive in the sense that they were quick.
Yeah.
Modern economic thinking does lead to quicker action than it would have done once. It probably wasn't a particularly efficient way of doing it compared with, I think, the Brits and the Europeans probably got a bigger bang for their buck. But still, I don't want to be mealy-mouthed about that. It would have been a terrible outcome had they not done so. So I think that all Americans have to be pleased that their government did act in the common good in that sense. It was encouraging that Americans were able to put aside their political divisions on this and agree that that was the right thing to do. So far, so good.
Now, I try to not talk about Brexit that much because I feel as though the last few years we've talked way too much about it. But, I do want to raise it now. What do you think about the prospects of Brexit now? We've obviously had COVID in the year where we're supposed to have a transition to some kind of new trade agreement. And so presumably that's delayed things. But what's your view of what type of deal the UK is likely to get? And then also, what's your longer term view on the UK in the context of Brexit?
If I could take the second part first and then the first part second, I think one can always be optimistic and should always be optimistic about the ability of economies to adjust. So if the United Kingdom wants to leave the European single market, in the fullness of time, it will be able to renegotiate satisfactory agreements with that single market, because it's in the interests of both sides to do so. And it will be able to negotiate satisfactory agreements with other countries in the world as well. So if you're willing to take a 10-year view, I have little or no doubt that the UK could, 10 years hence, have good trading arrangements with all the major trading regions of the world, as well as some of the smaller countries. And I say that because my own country, New Zealand, did exactly that in the late 60s and through the 70s, when it had to diversify its trade because the Brits kicked it out of some of their home markets, and they had to look around the world, and they negotiated agreements with China, they negotiated agreements with Japan, they negotiated agreements with the US, and indeed they negotiated agreements with the EU. So one shouldn't be pessimistic long term. What the experience, however, of Australia and New Zealand and other countries who had to adjust their trading relationships has been is that it takes time. And while that's going on, your GDP tends to be weaker than it would have been otherwise. You don't smoothly adjust from exporting on Friday to the EU and exporting on Monday morning to China. It just doesn't happen. It takes a long time. So part of the answer to your question, therefore, is how carefully has this been prepared? How well are exporters in this country prepared for this? How well is the country prepared for this? How well is the infrastructure prepared for this? Here, I must say, when I look at the United Kingdom, even before COVID, it looked to me a bit of a shambles. And now it looks to me to be an utter shambles, particularly on the UK side. For example, we saw the government declare that they needed to teach 50,000 people how to fill out customs forms, and then the policy collapsed. They then said that there would be inspection of goods when they arrive in this country, and they're now saying we're going to wave them through at least for the first 6 months. Well, maybe they are going to, but the Europeans aren't. So it looks to me as if this has been a poorly executed, imperfectly planned exercise. It's much more technically complicated than the waffle that we've been hearing would imply. So, and that was pre-COVID. So be clear what I'm saying. I'm not saying that it's a disaster if you change your relationship with the world's largest market. I wouldn't have done it myself, but it's not necessarily in and of itself a disaster.
Yeah, understood.
But it takes time to adjust, and if you haven't prepared carefully for that, the adjustment costs will be substantial.
Yeah. Now, one kind of undercurrent of recent years that's affected economies quite significantly has been the rise of populism in various economies. You've mentioned kind of the 70s oil shock sort of period. The 70s also was a period of great sort of political volatility. How do you think of our current period of this populism and seeming sort of polarization in kind of a historical context, first of all? And do you have an outlook on how it could develop in the next few years?
There have always been populists, of course, and there always will be. And by a populist, I think one means people who appeal to the electorate for a period with a slogan which purports to say that the problems are easier than they are to solve. We've seen that a lot in Latin America, and I think we've seen it in this country, and we've certainly seen it in the United States. In fact, the problems are always more complicated, more multifaceted than the populist makes out. And usually populists are found out because when they start trying to deal with the problems, if it's simple, it turns out not to be. The public gets disenchanted. So in a way, the issue is what comes after the populist. Now, if you've got a stable democracy, which one likes to think that we have in the United States, in the United Kingdom, on much of the continent of Europe, though not quite all of it, then you hope that you get through the period of populism. And then you come out the other side with an election. The ultimate feature, of course, the asset of democracy is that very last and as you can kick them out. And my guess is that what you're going to see is a replacement of populists with much less charismatic, much more technocratic leaders who appeal almost because they're boring, but they look competent because they'll run on a ticket of making things work rather than promising the moon. I suspect that that's what's going to happen. That's provided, of course, that you've got a stable democracy. If you don't, then a populist can risk being replaced by another populist and it descending into quasi-anarchy. But I don't think that'll happen. I think that the underlying belief in democracy in most of our Western countries will be sufficiently strong to carry us through this. As I say, the replacement of be eminently understandable if a Trump were replaced with a Biden and if a Johnson was replaced by a Starmer. That's exactly the type of person in both cases you'd expect to get when the pendulum swung.
Yeah, understood. Now, speaking of democracy, one of the big kind of themes in development economics or emerging markets is to contrast China and India. You know, you have India's very sort of noisy and vibrant democracy, slightly chaotic economy, and then you have China, authoritarian, centralized, but very successful economy. How do you kind of compare and contrast the two? And one way of doing that, I guess, would be to kind of talk about them in terms of their longer term outlooks.
Mm-hmm. I think there's a strong feeling amongst Western observers that as economies get more complex, as the challenges get more multifarious, the technocratic challenge to a government gets greater and greater. So they look, for example, at Singapore and say, now there's a technocratic government which is really taking very intelligent decisions for the long term, and it's standing them in good stead currently and in the future. So you look at Singapore and you say, there you are, there's proof that a technocratic government is what's needed. And when you look at the technocratic incompetence of some of the Western governments at the moment, it reconfirms you in that view by looking at the obverse of the coin. Then armed with that, we look at China, and what do we think? We think, well, they're quite technocratic ultimately. And furthermore, they can take a long view because they're not troubled by a 5-year political cycle or whatever. So we say, now that's the way to run a country because you can take good decisions. And there's no doubt that that works for the Chinese. They can take good decisions about strategic issues like the structure of the economy. They can take good decisions about pollution. They can take good decisions about renewable energy, and they can take them through. And that's a huge asset compared with some of our countries with short political horizons. But before we go overboard and say, therefore, that's what we want a Chinese system in which we can achieve that sort of decision, we have to recognize also that with that tends to come a lack of representativeness on the part of the individual in the economy. They don't have much say in any of this. And it's often a very small step to go from that neutral situation to this one where they're controlled, whether it's by CCTV, whether it's by controlling the internet or whatever it is. And then you get suppressed discontent. We don't necessarily see it. You'd have to be a local to know. When that happens, these societies can seem to be working along good technocratic lines and then suddenly explode. Now, India, I think, is the obverse of that. This is a country which has got nearly as many people. They're clever, they're educated, they're hardworking for the most part. It's got all of those things going for it, but it's chaotic, as you said, absolutely chaotic. Its infrastructure is lacking. It cannot take centralized decisions and push them through in the way that the Chinese can, but it is a democracy. You can, when the political term is up, throw the government out. And that is a safety valve. So if you want to be analogous, I've often looked at China, not just now, but always, as a pressure cooker with the valves slammed down shut. And India is bubbling over all the time, but it might prove to be long-term the more stable of the two. So it might be, it's not exactly a tortoise, but it might be the tortoise which at least keeps up with the hare on average over a long time.
Yeah, no, that makes sense. Yeah, we've covered kind of lots of topics in our conversation so far. Is there anything on your mind or your research agenda that we haven't really talked about that you wanted to raise?
Yes, I think one has to mention climate change, and of course, as soon as you do, an awful lot of people roll their eyes.
Yeah.
But they really mustn't. My father was a scientist. He explained to me how greenhouse gases work when I was 10 years old. We walked into a glass house, and I said, "Why is it so hot in here?" And he said, "Oh, well, because the sun's short wavelength rays pass straight through the glass, warm up the soil inside, but they can't get it back out because by then they're long wave rays, and those don't pass through glass." So I grew up with no, you believe the things your father tells you, and he had no agenda. So I grew up thinking, I know the essence, I know the basic point about greenhouse gases. So as soon as talk started about greenhouse gas warming, and I watched all the people who said, "Oh, it's not true," I thought, well, I know it's true. My father told me. So I think that gave me a head start on even a lot of my colleagues, let alone vested interests like oil companies, and even worse, the coal companies, who spent millions of dollars trying to persuade the public that it wasn't true. Now, I think we've reached the point of public understanding that the scientists had 20 years ago. The public is now accepting, yeah, there's probably something going on. I don't think the public, however, realizes that the 2-degree target that was set, or 1.5 to 2-degree target that was set by governments at Paris, is not going to happen. That's dead. That's cloud cuckoo land. You have to be working now with an assumption of 3 degrees as your base case. And we advise our clients to challenge their stress test their investments against 4 or even 5 degrees. And in that context, India is now planning on 4 degrees as its base case, and good for India, because they should be. And at 4 degrees to 5 degrees, the world as we know changes almost unrecognizably in major parts. So the discussion about climate change, from my view, just does not remotely have the urgency that the laws of physics would dictate.
I mean, in that extreme scenario of the 4 to 5 degrees, how would that affect, say, the US, who's obviously one of the biggest economies in the world, and they need to come on board with climate change? But would it directly affect the US?
Oh, good heavens, yes. I mean, to start with, by the turn of the century, sea level would be several meters higher.
Okay.
And so immediately you're talking about significant parts of Florida being underwater, New York being underwater unless it puts extremely expensive barriers around it and so on. Yes, that it really does. It also turns parts of the Midwest into almost into a dust bowl, certainly not into an agriculturally viable area. And then, of course, it doesn't stop there, you see, because the world is one place. India really does suffer under that situation. I mean, 3/4 of Indian labor force and half of Indian GDP is directly exposed to temperature. And so if you're talking about a 4-degree, let alone a 5-degree rise, you're talking about very big effects. China is affected, as is India, by water supply being reduced 30-40%. Pakistan and Bangladesh are affected because large parts of Bangladesh go underwater. And where do those people go? So the point I mentioned towards is migration.
Yeah.
So no country, not even the US, is an island in this respect. And Europe Certainly isn't. If Europe can't handle the small numbers who are coming across the Mediterranean from North Africa, how are they going to handle a hugely greater number who will be pressing northwards as a result of more desertification? On present policies, they simply can't. There are people who talk in these terms. I know the Americans, for example, in their planning have asked themselves one question: where could you move all the Bangladeshis to? There's nowhere that they could obviously fit except perhaps Siberia. I mean, you're talking about very, very big effects here.
Okay, yeah. That's really quite dramatic, really, and
it's dramatic.
When you put it in those terms, it really makes one think that we really aren't focusing on this enough.
Yeah, and you can say it's 80 years away before the turn of the century, but that doesn't mean nothing happens until the clock ticks past midnight then, and we're not very good. As we're not as good as ants are planning for the future. And look at Brexit. As I've said, go back to that discussion. That could have been executed relatively smoothly. It looks instead like being a complete and utter screw up simply because of a failure to plan. So I would suggest is the risk that we face with climate change, not least because the planning has to involve intergovernmental cooperation, which has been going the other way.
Well, we've covered so many topics, and I imagine we could talk, for hours longer. But I think we should probably wrap this up now. So first of all, I just wanted to thank you for your insights, but also if listeners wanted to get hold of your thoughts, your analysis, your research, what's the best way of people following your work?
Through our website. Thank you very much. Yes, it's www.llewellyn-consulting.com, and we would be delighted to talk. Of course, we've talked at a high level, and a lot of our work that we do is at a more tactical level and a more strategic level than this. But yes, we'd be delighted.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.